Hi. So we have seen various financial institutions that exist in India. Apart from the traditional banking system, traditional lending, there is something which has cropped up, and then that is called investment opportunities and investment institutions in India. Venture capital investments, to be more precise. So there were various mutual funds that came into existence, public and then private as well. So we had regulatory bodies which was regulating all these investment details also. And we have Board for Financial Supervision. We also had Deposit Insurance Credit Guarantee Corporation, DICGC, and Export Credit Guarantee Corporation, ECGC. And we had 6 regulators: Reserve Bank of India, Securities and Exchange Board of India, SEBI, then IRDA, Pension Fund Regulatory Development Authority, National Housing Bank, and 2016 they formed Insolvency IBBI, Insolvency and Bankruptcy Board of India, to take care of IB corporates. So these are some of the latest development on the financial sector in India. So let us go briefly on to the investment institutions that are currently available for the general public and the corporates as well. Under investment institutions, we have insurance institutions and mutual funds. These are the two broad categories under the investment institutions. One is insurance, another one is mutual fund. Under insurance, we have life insurance, LIC. We have GIC, General Insurance Corporation. This is for non-life insurance purpose. Former subsidiaries of GIC, there are 4 of them. And then new life insurance companies that came up, 13 of them. And new general insurance companies that came up, there are 8 of them. So these are the various insurance institutions under investment institutions. So under investment institution, we also have mutual fund. Under mutual fund, we have public sector funds and private sector funds. Under the public sector banks, we have bank-sponsored mutual funds, financial institutions-sponsored mutual funds, UTI mutual fund, and the specified undertaking of UTI. So these are the various mutual fund options available apart from the private sector mutual funds. So what are the insurance companies that was prevalent? Life Insurance Corporation and General Insurance Corporations were LIC and GIC. They were the predominant leaders of insurance companies. After Malhotra Committee recommendation in the year 2000, it threw open to the sector. Actually, 1994 was the period it was thrown open to the mutual fund industry for the private sectors to come in. So 2000, in the year 2000, public sector insurance institutions were predominant till 2000. After that, the private sector players took a prominent role in tying up with the banks and various financial institutions. This is enacted Insurance Regulatory Development Authority, IRDA, in the year 1999 to regulate these mutual fund insurance companies, and mutual fund companies are governed by SEBI, as you are all aware. So this is to control, regulate and develop the insurance companies in India. IRDA mainly played the role of controlling the various disputes that arise and for governing purpose also. So LIC, GIC, apart from that, there are various private insurance companies that came up. 23 to be precise, new private sector companies were established in the field of life insurance. Out of which 21 are in joint venture with foreign companies. Then 21 private insurance companies have commenced operation in the non-life sector as well. 23 in the life insurance sector, 21 in the non-life insurance sector, out of which 18 are in collaboration with the foreign partners. So this is a brief about the insurance companies in India. Then we have mutual funds. I'm not going to touch upon various funds available in the mutual funds. You are all aware. We have various sectoral funds are there. We have fixed guarantee income funds are there. For income tax purpose, there are funds available. Then you have new IPOs coming up under the mutual fund scheme. Initial public offers that come under that. So I'm not touching upon that. So we restrict ourselves with the UTI that was formed under the Act of Parliament in 1964. That is a major chunk of mutual fund industry in India. In October 2002, the UTI Act was repealed, and it was split into two, under which one is UTI mutual fund, the other one is specified undertaking of UTI, where they were all stressed MF funds. This is governed by SEBI, as we broadly came to know that the Securities and Exchange Board of India govern the mutual funds in India. So mutual fund does play a very, very prominent role in widening and strengthening the capital market in the country. This is about mutual funds. So we have seen about insurance industry and then about mutual funds. Now primary dealers, who are they? They play a very significant role in government security market. So this is again introduced by RBI in the year 1995, designed to facilitate government market borrowing program and improve the secondary market trading system. To improve these two, primary dealers are formed. At the end of June 2012, there are 21 primary dealers in India. So as we have seen in the insurance sector, 23 new private sector, 21 new private sector in the general insurance. Same way, we had 21 primary dealers in India. 13 of them were banks out of which. 8 standalone primary dealers registered as NBFCs, non-banking finance companies, under the Section 45IA of the Reserve Bank of India Act 1934. So primary dealers, they deploy their resources largely in government securities bought besides commercial paper and corporate bonds. So these were the main investment areas where these primary dealers were focusing. So what is NBFC? Another growing and established sector, non-banking finance companies. Mainly functions as leasing and hire purchase. Mainly they do this, loans and investment companies. And they are to a limited extent governed by Reserve Bank of India. These non-banking finance companies, they are of diverse nature, which have contributed significantly in the development of the Indian economy. So these are the various investment and other financial sectors. One is the insurance company, the other one is mutual fund. Then we have seen non-banking finance companies apart from the primary dealers. And then comes certain insurance companies that facilitate or give guarantee to the customers in general. They are DICGC, Deposit Insurance Credit Guarantee Corporation. Then Export Credit Guarantee Corporation, ECGC. And we have, as we told in the beginning, the regulatory authorities that take care of all these financial institutions. So to come to know about DICGC, this is established under the Act of Parliament in 1962. It took over the undertaking, actually the Deposit Insurance Company started like that. It took over undertaking of Credit Guarantee Corporation, and hence it is renamed as Deposit Insurance and Credit Guarantee Corporation with a share capital of 50 crore, wholly by Reserve Bank of India. The corporation performs the function of insuring the bank deposits. When it began, it was with every customer was insured to the tune of 1 lakh. Actually, in India, if you see, as far as my knowledge goes, I have been into banking since 1989, close to 33 years of I have been seeing any bank actually failing. I have seen bank mergers, to be precise. When Global Trust Bank was under so much of stress, the depositors were taken care of, RBI came into, and there was a little moratorium for some period. After that, Oriental Bank of Commerce took over Global Trust Bank, you are all aware. So in India, the banking system never failed because of the robust controlling measures which is available to take care of the interest of the depositors. And hence, DICGC plays a prominent role in ensuring the interest of the depositors. And up to 1 lakh of customer amount is in one customer ID is insured under DICGC, and banks pay a marginal premium towards it. And then comes ECGC, Export Credit Guarantee Corporation. This again the Government of India undertaking, plays a prominent role in the export promotion and export finance. It also protects from the risks inherent in selling to foreign countries. What are the risks one is commercial, the other one is political. Under commercial, insolvency of the importer, default on his part to pay for the goods, or failure of the importer to accept the goods. So these are the three main risks that is involved under the commercial. One is insolvency of the importer. Second one is willful default. Third one is importer refusing to accept the goods. Then political risk, you are all aware, transfer of payment in rupees, there may be restrictions, war between two countries, and insurance charges arising from these kind of interruptions. So this is taken care by ECGC. The corporation reimburses the exporter a specified percentage of the loss incurred. So they also take care of, ECGC takes care of pre-shipment and post-shipment for producing, packaging and exporting the goods. So then comes the regulatory authority. We have Reserve Bank of India that takes care of the banking and the financial institutions. SEBI, Securities and Exchange Board of India, this is for mutual fund industries that is existing in India. Then IRDA for insurance purposes. Then we have National Housing Bank that takes care of the regulatory and supervisory authority of housing finance companies in India. Then Pension Fund Regulatory Development Authority, PFRDA, takes care of pension funds. And the last one is IBBI, that is formed in 2016, Insolvency and Bankruptcy Board of India. This takes care of insolvency participants, IPs, and the corporate insolvencies also. Broadly, the Board for Financial Supervision, RBI set up the Board for Financial Supervision in November 1994. It has been entrusted with the task of supervision of commercial banks, select financial institutions and NBFCs. The board reviews the monitoring by the RBI with regard to bank frauds and housekeeping in public sector banks. So this is very, very important institution that takes care of the regulatory and the corporate governance of the banks. The board also reviews the monitoring of select all Indian financial institutions and NBFCs over which RBI has regulatory jurisdiction. The board points out the course of action to be pursued in each specific case and provides guidance on several regulatory and supervisory policy. The board has approved a supervisory rating model for the financial institution which has been introduced from 2002 and 2003. So with all these regulatory bodies, so one thing which you need to ensure is India is so poised towards ensuring that each depositor, individual as well as corporates, are safeguarded on their investments which is happening in India. And hence, the robust financial system under the supervisory control of these 6 regulators, the financial system is very stable and then delivers up to the expected requirement. Thank you very much for patiently watching. Bye.